the first and greatest risk always, I guess, is inflation. You know, there's possibly some upside inflation risk in the near term through oil prices with, you know, tensions in the Middle East, the possibility of some sort of conflict between the US and Iran, for example. If we were to see that, we'd see that actually probably more as a shock to growth, a downward shock to growth, rather than really a more meaningful upwards risk to inflation. So we don't really see that as the driver. In terms of longer term inflation risks, I think you know, the macro environment is such that those longer term inflation risks, which, you know, at high debt levels, you know, have to be considered. I think they're too far in the future to really worry about just for now. We talked about liquidity risk in credit. Probably we need to see an event of some sort to materialise liquidity risk. So we need to see, you know, a bank blow up or a big hedge fund manager get into trouble. It's always hard to know in advance whether you're going to get these things. They're hard to identify. We don't think there's the same degree of leverage in the system as there was prior to the GFC, so it's not as obvious that we're going to have an event. But, you know, there are a few things bubbling around that urge you to be a bit cautious. And then finally, I think this is really a longer term risk, the possibility that central banks change their regimes. You know, they've been focused on targeting a very narrow measure of inflation, consumer price inflation, and they've had fairly limited tools at their disposal. If they were to change their policy framework, if they were to say we're going to target, you know, a much broader measure of price inflation, including assets, you know, policy probably wouldn't be as accommodative. Or if they change the tools that they used, including maybe, you know, coordinating with fiscal policy in a more material way, you know, the game probably changes a bit. But, you know, right at the moment, central banks are actually doubling down. You know, they've tried all these stimulatory measures over the last decade, haven't really had a lot of success in terms of real economy outcomes. But in spite of that, they're trying even harder at the moment. You know, there's a whole round of easing going through, you know, including by the RBA. We're not in unconventional territory yet, but we're actually not too far away. So, you know, central banks, I guess, are sticking to their guns, but there's a risk at some point that they could change approach, and that would be, well, destabilising for fixed income markets for sure. Pretty high. So the RBA has made it pretty clear they don't want to take rates negative. I think they've learnt from the experience of elsewhere that creates problems for the banks in particular, and a whole heap of sort of disincentive issues. But obviously they've done the groundwork in terms of you know, how to apply QE. They've again learnt from experience elsewhere. Australian market's a bit different. They'd apply it a bit differently. But look, you know, we think the cash rate is going lower in the near term. Next step, assuming they stick with their inflation targeting mandate and they're not able to generate inflation, next step would be QE in some form, and probably it's actually going to be you know, look different to what's happened elsewhere. It probably doesn't involve a whole lot of long-term government bond buying. Probably it's mostly focused in the short end of the curve, providing liquidity essentially to be able to allow banks to price more effectively.